Hi, and welcome to the Global Opportunities Quarterly Update. My name's Martin Van Eyck. I'm one of the members of the distribution team here at Magellan. Today, I'm joined by Portfolio Manager Alan Pullen. G'day, Al.
Hi, Marty. Thanks for having me.
Kick things off, let's start up with a bit of an update. So can you give us a bit of an update over the last quarter, what's been going on, anything that sort of stood out that you really noticed?
Plenty happening in markets and around the world. Of course, we started this quarter, 2nd of April, with Liberation Day. So the Trump trade and tariff announcements, which spooked markets. We saw very quickly over a course of 2 or 3 days, a 10% decline in markets as people worried about what was going to happen to the global economy. We took a view at that time that Trump was mostly negotiating, that these were negotiating tactics. So we took that opportunity to actually lean in slightly where the opportunities were on some of those stocks. And indeed, the market did recover remarkably quickly as we started to go through some of those tariff announcements. Of course, he delayed tariffs, says he's doing deals, and those are still underway. And the markets were remarkable in the speed of their recovery. They actually ended up for the quarter more than 10% in US dollar terms. The Aussie dollar was weak during that period. So in Australian dollar terms, the portfolio delivered more than 5%, but still a very solid performance for the quarter. In terms of other key events and what's going on, there's just so much going on. We've of course seen the Middle East. That's been a tinderbox, and we saw deterioration there. Once again, markets just seem to power through that to a degree. Somewhat surprising, but when you look under the hood, actually, the US market and the global economy is much less dependent on Middle Eastern oil than it used to be. US, for example, is energy independent, and actually you could argue is almost a beneficiary of higher energy prices given they're an exporter. We have to think about the impact on inflation, but underlying that, it wasn't going to have a huge impact on our stocks and the market. So probably a fair reaction actually after that. So a lot happening in terms of that geopolitics. We've got the big, beautiful bill, of course, is in debate right now. And our markets have been performing remarkably strongly throughout that period. A lot of that comes to the underlying companies, of course. Markets are just a component of those underlying stocks. And we saw a lot of strong performance from and enthusiasm into the AI plays again this quarter. They were a little bit weaker, if you recall, in the first quarter. We had the DeepSeek impact call into question, I guess, parts of that trade. But we certainly saw in the second quarter those companies continue to kind of deliver strong returns for investors. And when I look through the portfolio, it was more those tech-type companies. Microsoft was up 30%. TSMC was up more than 20%. We also had Meta up strongly as well. So those companies are exposed to the AI trade, performing really, really well. And it wasn't just due to kind of the change in narrative. It was because they're delivering really strong earnings. So we saw Microsoft, for example, delivering very strong earnings in the quarter. Azure accelerated to more than 30% growth. So that's very exciting. But the defensives lagged a little bit, as you'd expect in such strong markets. But we saw what an important role they play in the first quarter. So we're very comfortable with that. But there were some interesting stocks as well. Dollar General was up strongly, which was a defensive stock, but had some idiosyncratic things go positive for it.
Okay, so you've mentioned Dollar General. Now that's a company that people in Australia won't be as familiar with. Can you give us a bit of a background on that, who they are, what they do, where they fit into the whole thing?
Yeah, absolutely. Dollar General is a US company. They're a discount retailer. Okay. So they've got a fairly unique footprint. They've got almost 20,000 stores throughout the country, but they're very small format, and they typically reside in more rural areas with lower income populations, and they serve that lower income population with their basic essentials. So 80% of what they sell is what we call consumables, people buying everyday needs type thing. It's quite a unique footprint in that they don't really compete against some of the really big retailers like the Costco's, right, where you go to do your massive shops. These guys are mainly the fill-ins. And because of that, it's a very stable business. The average basket size is around $12, around 5 items. So not a lot of competition from online so far. And just a very defensive company because it serves those everyday consumers and their needs. They had a few execution issues over the past few years. They had rising shrink, which is a lot of theft. Okay. They had some issues with stockouts and so on. Really just operational stuff, which saw this company, which is typically traded well into the 20s in terms of price earnings ratio, fall into the low teens. And we found that pretty attractive as an opportunity. Something offers defense to the portfolio, but also a re-rating potential as we determined those factors were mostly within their control to fix. They put in the old CEO, who has led this business for many, many years, and we are starting to see those operational improvements come through. They did things like kind of rip out the automatic registers and go back to having people at the front of the store to help with theft. Pretty simple stuff, making sure that all their items are in stock. Just really good retailing. They're a really strong operator. So that's been a good performer in the portfolio so far. It was up again around 20% in the last quarter.
Can I get you to take us through a bit of the evolution of the portfolio over the last 3 months and what's actually changed? Anything in their position weights worth noting? Anything like that?
Not a huge amount of change over the past quarter. There has been one new stock come in and one new stock exit. We can't disclose those yet. We're happy to talk about them as soon as we can, but it was largely a like-for-like type exposure. We weren't trying to change the shape of the portfolio as such. Really, one just reached its valuation and we switched it out for a company we thought offered similar opportunities, but with a more attractive valuation. Within the portfolio, there are a couple of notable changes, I guess. We have been trimming Alphabet somewhat. And I'd say this is one of the most hotly debated stocks within the investment team right now. We've owned Alphabet, Google, for a long time now. It's been a very strong contributor to returns, but they are facing a real headwind in their key business, which is, of course, search. And we've talked a lot about AI over the past couple of years, and we're really excited and positive on some AI themes and the opportunities for our companies. But this is one where it could be a real headwind. If people stop using that traditional Google search and instead search through a large language model like OpenAI, that's a threat to Google's main income stream today. Now, we still like parts of Google. YouTube is an amazing business and is not threatened. Waymo, we're hearing more and more about Waymo. We think that's worth around $200 billion as they continue to roll out around the world. But it could be more than that, given the early stage. And of course, Google Cloud Platform, one of the three greatest businesses on the planet, those public hyperscale cloud providers. But today, more than 80% of earnings still comes from that traditional search. So we're cognizant of the potential threat there over the next few years, and we've been very carefully looking at the position size for that stock.
Oh, fantastic. Now, I guess looking forward, gazing into the crystal ball, what about positioning going forward, and what are the things that are sort of, I guess, you're really keeping at the forefront? What's concerning you about what's coming towards us? What excites you about what's coming?
Well, there's been a lot coming, and I expect it to continue. We've, of course, we did get Liberation Day, and we saw Trump walk back a lot of those initial tariffs, but there's still a lot of debates ongoing. The market's really powered through a lot of that debate, and it's left valuations, I would say, full. We're certainly not in bubble territory, but it's hard to find real bargains out there as well. So in terms of the overall portfolio positioning, we're mindful that if something does go wrong, there's not a lot for that in the price. Now, our base case is we continue to muddle through. We've got the big, beautiful bill working through Congress as we speak, and we expect that to be mildly stimulatory to the US economy. We expect the trade deals to get done and the US to be okay. So that's not a bad backdrop for markets, and we continue to grind higher. But if something does happen to go wrong, and given all the noise that we're seeing from politicians and so on, we certainly can't rule that out. Any damage to come throughout the economy, potentially from what's already occurred in terms of tariffs. So we're continuing to keep a defensive bias within the portfolio. Having said that, over the long term, we're still really excited about the opportunities in AI. We continue to lean into Microsoft, just really well exposed there. They performed well last quarter, but it came from earnings growth. Azure is growing at 30%. It re-accelerated. A lot of that is driven by AI, that incremental demand as well. So this isn't some pie in the sky future opportunity. This is starting to impact those companies today. Same with TSMC in the chip space. So we're still seeing really good opportunities there over the long term, but it wouldn't be impossible to see a hiccup in the nearer term, just given where valuations are. So summing it all up, it's been a really strong period for performance. Obviously, not just over the past quarter, but the past year and the past 3 years. The Magellan way of analyzing stocks, it works, it delivers returns for clients over that long term. And the stocks that are in there, I'm confident will continue to deliver for clients over the long term.
Well, thank you, Alan. And thank you for watching. If you would like further information on the Global Opportunities Fund, please feel free to contact any of us in the distribution team here at Magellan or jump onto our website. And if you would like to share this video with any friends or colleagues, you're welcome to as well. Thank you.